How working class people can escape the matrix and build wealth like the upper class. The phrase escaping the matrix gets used online as shorthand for breaking free from the paycheck cycle. For many working class families, that cycle isn't fictional at all. Inflation, flat wages, and high living costs eat up most of what gets earned before it reaches a savings account. Getting out takes more than picking up an extra shift. It takes a different relationship with money entirely. Let's look at how working class people can start the process of escaping the matrix and build wealth as the upper class does. 1. Recognizing the rules that keep you trapped. 3 patterns do most of the work of keeping income spent immediately rather than building it up for wealth. Spotting them is the first step toward breaking out of the loop. High-interest debt works like financial gravity. A credit card balance or an expensive car loan pulls future income into paying for past spending, and the interest adds up faster than most people expect. Lifestyle inflation is quieter but just as costly. A raise often gets absorbed almost immediately by a nicer car or a bigger apartment, so the excess income to expense ratio resets to 0, and the next paycheck still feels just as urgent as the last one. Taxes add a third layer. Wages get withheld and taxed right away, often at a high rate. In contrast, income from investments and business ownership is frequently taxed at lower rates or reduced by deductions that most employees never have access to. 2. Shifting from spending to saving and owning. Upper-class households don't get rich by buying consumer goods. They get rich by owning the businesses and investments that other people spend their money on. That shift starts with a stretch of living below your means, often for a year or two. It isn't permanent deprivation. It's how someone buys the first real bit of breathing room. Paying off high-interest debt during that stretch functions like a guaranteed return few investments can match. A card with a high interest rate costs more each month than most market gains could offset. An emergency fund covering several months of expenses serves a similar purpose. It keeps a car repair or a medical bill from sending someone back into debt just when they're starting to make progress. 3. Turning income into assets that work without you. A salary has a ceiling no matter how large it gets. Real wealth tends to come from redirecting some of that income into assets that keep producing value after the work is done. Owning shares in public companies through broad index funds is one of the simpler entry points. Automatic contributions let compounding work in the background for years without requiring much attention. Digital products work similarly on a smaller scale. An ebook or a short course is built once and can sell repeatedly, turning a single block of time into recurring income. Small service businesses follow the same logic for people who prefer a more hands-on approach. Consulting or web design can often start with little upfront cost through free online marketing. Rental property follows a similar pattern for people willing to take on the management involved. A property that brings in more rent than it costs to maintain turns into another stream of income that doesn't depend on showing up to a job every day. Business ownership stretches the idea further. A company that keeps running without the owner present every hour starts to behave less like a job and more like an asset, whether it's a local service company or an entirely online one. 4. Multiplying effort without multiplying hours. There are only 24 hours in a day. Trading every one of them for money puts a hard ceiling on what anyone can earn, so building wealth usually means separating income from time. Hiring people to do work is one way to multiply output, though it usually requires money that most working-class households don't have early on. Putting existing capital into investments accomplishes something similar once enough has built up. Software behaves differently, since it can run continuously once it's built and keep generating value without anyone actively working on it. Content does the same thing. An article or a video gets made once and can keep reaching people long after the work is finished. For someone starting without capital, software and content tend to be the most realistic starting points. Both can be built with time and skill alone. 5. The mindset shift that makes it stick. None of the strategies above sticks without a change in the thinking behind them. Habits built on the wrong mindset tend to fade fast. Trying to look wealthy is one of the quieter traps in the middle class. Luxury purchases often signal a status someone doesn't have, and people who are genuinely building wealth usually spend less on appearances than outsiders assume. Money spent buying back time is usually money well spent, even when it feels indulgent. Paying for service that saves 2 hours a week only makes sense if those 2 hours go toward a skill or a business instead of more downtime. The people closest to someone shape how fast this shift happens, too. A social circle that spends every weekend complaining about money while running up debt on temporary distractions tends to pull a person back into the same loop, no matter how disciplined their own habits are. Conclusion. Breaking out of this cycle has less to do with luck and more to do with redirecting spare dollars and spare hours toward things that keep producing value on their own. A tighter budget usually comes first, and sharper skills tend to follow not long after. Owning assets instead of just buying things is what eventually turns that effort into something lasting. None of it happens overnight, but the direction matters more than the speed.